Welcome to this explainer. Today, we're taking a hard look at the data to untangle the massive hype surrounding the AI boom from the actual, underlying financial fundamentals. We're hearing the alarms ringing everywhere, right? Is the explosive rise of AI an exact repeat of the catastrophic 1990s dot-com bubble? Or are we witnessing the dawn of a permanent, fundamentally sound technological revolution? Let's let the numbers do the talking. To figure out where we're heading, we're going to hit 5 key areas. First, the echoes of the dot-coms. Second, those alarming AI bubble similarities. Third, why AI is actually different. Fourth, the massive infrastructure gamble. And finally, crash versus correction. All right, Section 1, echoes of the dot-coms. Validating the market's anxiety. So let's get right into it. If you're sensing some real market anxiety right now, you're definitely not alone. A recent survey showed that 54% of global fund managers think AI is in a massive speculative bubble. And honestly, when you look at the sheer velocity of capital, it makes complete sense. In 2025, 61% of all global venture capital funding, we're talking a staggering $258.7 billion, flowed straight into AI startups. That's the kind of money moving at a speed that naturally brings back some serious late 90s internet rush flashbacks. Moving to Section 2, alarming AI bubble similarities, where 2026 rhymes with 1999. Here's a massive red flag for you. Just like the absolute peak of the dot-com boom, market concentration right now is at a 50-year high. Basically, the entire S&P 500 index hinges on the fortunes of just 5 mega-cap tech giants. They hold 30% of the market weight. Back in '99, it was Cisco, Intel, and Microsoft running the show. Today, the fate of the broader market is completely tied to just a handful of AI pioneers. And having things this concentrated, it breeds incredible fragility. Remember the DeepSeek shock in January 2025? A Chinese startup drops a highly capable, incredibly cheap-to-train AI model, and the market absolutely panicked. In a single day, that shock wiped out $588.8 billion of NVIDIA's market cap. That is literally the largest single-day loss for any stock in history. When valuations are stretched this tight, just a perceived shift in the wind can vaporize $500 billion overnight. Plus, the private markets are flashing some classic bubble signals. Back in the dot-com era, we saw internet startups with zero path to profit trading at astronomical price-to-sales ratios. Fast forward to today, and we've got completely unproven, zero-revenue-generative AI startups valued anywhere from $400 million to $1.2 billion literally per employee. Just let that sink in for a second. Capital is flooding into unproven hands at a breathtaking rate. Section 3. Why AI is different. The fundamental antithesis. Okay, but before we go calling this a total house of cards, let's pivot. We really need to look at why the unit economics of today's AI leaders are fundamentally different from 1999. Back then, only about 14% of dot-com companies actually turned a profit. It was pure speculation. But today, the companies leading the AI charge, NVIDIA, Apple, Microsoft, they are established cash flow behemoths. I mean, NVIDIA alone posted nearly $216 billion in revenue for fiscal year 2026, pulling in massive margins. We aren't dealing with Pets.com here. We're looking at historic corporate profitability. And that historic profitability completely changes the math on broader market valuations. In March of 2000, the NASDAQ 100 was trading at a dizzying forward price-to-earnings ratio of around 60x. Today, looking at early 2026, the S&P 500 is trading at a stretched but comparatively much lower forward PE of roughly 23x. Sure, NVIDIA's total market cap might be in the trillions, but its forward PE is sitting around 30x. The key takeaway? Yes, valuations are undeniably high, but they are absolutely nowhere near the 60x speculative excess we saw at the dot-com peak. It all comes down to what's driving those valuations. From 1995 to 1999, 314% of the tech sector's massive return was driven by pure multiple expansion. Basically, investors were just hyped and willing to pay way more for the exact same dollar of earnings. But check out 2021 to 2025. 78% of the AI tech sector's return has been driven by actual earnings growth. Today's price appreciation is overwhelmingly backed by a structural increase in real earnings power, not just a catchy narrative. And what's backing up those earnings? Rapid, real-world adoption. As of right now, 71% of organizations are already regularly using generative AI in at least one business function. OpenAI has hundreds of millions of weekly active users. Compare that to the year 2000, when massive chunks of the global population weren't even online yet. Section 4. The massive infrastructure gamble. uncovering the real risk. Now, here's where the plot really thickens. When we look past the software and focus on the physical hardware needed to actually run this AI revolution, things get a bit dicey. The real risk isn't just software valuations. It's this unprecedented physical infrastructure build-out. The big question is, are we repeating the dark fiber telecom disaster of the early 2000s, where companies laid thousands of miles of fiber optic cables for internet traffic that took a full decade to actually materialize? Because big tech is absolutely not holding back. They're projected to spend up to $700 billion on AI capital expenditures in 2026 alone. You've got Amazon, Google, Microsoft, and Meta buying up GPUs and building these massive data centers at breakneck speed. It's a historic physical build-out, basically constructing Internet 2.0 from the ground up, all betting on this huge wave of future AI demand. But it's worth pointing out that the macro conditions of these two huge infrastructure phases couldn't be more different. The 1990s build-out was heavily funded by speculative IPOs in a rapidly globalizing world. Today's gamble, it mostly relies on corporate free cash flows and debt from companies that are already highly profitable. Plus, we're operating in an era of deglobalization and intense geopolitical competition. And our primary bottleneck today isn't unlit fiber cables, it's actual physical power generation and energy grid capacity. But here is where the math gets intensely challenging. To actually justify this staggering infrastructure spend, leading analysts like Bain estimate the AI industry will need to generate $2 trillion in annual revenue by 2030 just to meet worldwide compute costs. $2 trillion. That is a monumental financial hurdle. And that creates a massive revenue gap that we really need to pay attention to. Especially when you look at recent MIT research from late 2025, they found that despite pouring tens of billions into enterprise AI, 95% of organizations are currently getting absolutely zero return on their generative AI investments. Companies are spending a fortune to install the technology, but they just haven't figured out how to extract tangible, bottom-line financial value from it yet. Section 5. A crash or a correction? Synthesizing the future. So bringing all this data together, what should we actually expect over the next few years? Well, the consensus right now points to a selective correction rather than a total systemic collapse like we saw in 2000. We'll likely see an elimination of those smaller zero-revenue AI startups that are just burning through cash without a real business model. But because the giant tech companies leading this wave are immensely profitable, they have the cushion to endure a pullback. Ultimately, experts believe this clears the way for a genuine long-term productivity supercycle. Just be aware, analysts peg the highest risk window for a stock correction right now between 2026 and 2028. At the end of the day, the future of this market hinges on one absolutely critical question. Can AI actually generate the required $2 trillion in revenue before the market loses patience with the massive infrastructure spending? Will the measurable productivity gains catch up, or is a massive market reckoning inevitable? As you watch these trends unfold, ask yourself, how much patience does the market really have? Thanks for joining me on this explainer, and keep your eyes on the data.